Just give us your perspective on what we're seeing right now in the rates market.
Well, I think the interesting thing is if you look at it since the beginning of the year, it's actually been a real yield move. So it's not an inflation push. So I know there's all this talk about people worrying about inflation, but the data is not backing that up. It's more of a concern that actually with the tax cuts, perhaps there's going to be a lot more growth. And I think people are beginning to worry a little bit more about the U.S. budget situation.
All right. So the White House economic advisor, Kevin Hassett, said just minutes ago, he was talking about how we could reach 3% growth without seeing substantial inflation. Do you agree?
I think that's right. I mean, our view is we're going to hit 2.8 this year, and we don't have a lot of inflation. And you take it up by another two tenths, it's not going to be probably a material difference in the inflation.
Even with wages increasing?
Well, what then matters is productivity, and our view is that productivity is going to pick up with growth. We think part of the reason productivity has been so weak is because growth has been so weak.
Can the tax reform efforts, especially to the extent at which it accelerates capital investment, expand the productive capacity of the economy?
It can if it provides the right incentives. So if companies, take their savings and invest them in employees, or they invest them in capital equipment, they try to make themselves more productive. And of course, companies are always trying to make themselves more productive. I mean, that's kind of what competition does. I think the answer to that is yes. I think it can help things. It doesn't have to, though. It's not always the case.
And Kevin Hassett did say that it would bring new people, fresh workers into the workforce if we did see that.
If we see that rise in wages. So if this rates increase, as you said, not really an inflation story. What explains the seeming or the shift we've seen in the volatility regime?
Well, I mean, I think that there are a few things, but I think that the one thing is that people realize that perhaps, well, the simplest thing is just volatility had gotten way too low.
Yeah.
I mean, you have so many moving parts in the economy. You have the tax cut, you have the budget situation. You have the unemployment rate very low. You have this idea that inflation is going to be low forever, which kind of took a hit with the average hourly earnings and then the inflation report. And all of a sudden, people realize that, hey, wait a second, maybe the level of volatility isn't the right level of volatility, given the fact that there's 20 moving parts and we can only watch 10 at a time. All right? And so it's just silly to have that low of a level of volatility when you have that many unknowns.
If the Fed raises rates 3 or 4 times this year, as many expect, could that lead to an earlier downturn in the economy? And pricing that in, when do we see that?
I don't think so. So our view is that they probably won't hike rates that many times. We actually don't think 10-year yields will move up enough to allow that many rate hikes. But I would say if we do see that many rate hikes, what we're probably seeing is a response to higher growth and trying to curtail upward pressure on the 10-year yield. And so, when the Fed hikes rates, they're not trying to slow everything down just for the sheer joy of it. What they're trying to do is maintain a long-term lower interest rate than would otherwise be the case. And so I think if the Fed's hiking rates that way, they're doing it because otherwise the 10-year yield is going to move up much more quickly. And so we should view it as a positive with them hiking rates in that way.